Welcome to Let's Talk Money, Honey, the podcast where we break down the barriers to financial success.
I'm Elise Levy here with Holly Henry, and we're your hosts, two financial advisors on a mission to demystify investing, unravel the complexities of money, and sprinkle a little wisdom into your life.
Whether you're a seasoned investor or just dipping your toes into the world of finance, join us once a month as we discuss how to navigate life's financial twists and turns. Just remember, building wealth and living your best life should be empowering, not intimidating.
So listen up and let's talk money, honey.
All right, welcome to another episode of Let's Talk Money, Honey. And for July, we thought it was really appropriate to talk about how emotions and the market do not mix. And so, how to understand what market volatility really means and how to handle it as an investor. So, Holly, what's going on in the world today that would cause so much volatility?
I think that with every client meeting that I've had in the past few months, everybody has asked, how is this presidential election going to impact investing? Do we jump out now? Do we jump in later? How do we navigate this? And the election has caused the market to go up and down, both nominees, and not even just the nominees. Let's talk about any time that the Feds speak. It's like the market goes up and down.
Yeah, actually, any government entity opens their mouth.
And absolutely. We've seen it when Biden and Trump have talked about regulations that they want to be put in place. I mean, we've seen it a little bit this week with like the AI stocks. And so this is not abnormal, but what I do feel like we have to remember is one, you don't time the market. So we don't know when to jump in. We don't know necessarily when to jump out. What we are here to just say is investing is a long-term strategy and volatility is not new. Whether it's a presidential election, whether it's we're dealing with inflation and the feds are speaking and every time, like we said, when a government entity speaks, there's normally some sort of volatility that happens. This is not new on what we're facing.
No, absolutely. And I think it brings in, I think you said, volatility is not a market strategy. So it makes me think of modern portfolio theory, which I think we try to use for most of our clients. And so, like, what is modern portfolio theory? It's understanding that each asset class will have its day. So, growth stocks have been dominating the market for the past couple of years, but that's not going to continue for forever. So value stocks will have their day, emerging markets will have their day, international stocks will have their day. So that's why when we make a balanced portfolio for you, you're actually exposed to all those different asset classes because exactly what Holly said, it is impossible to time the market. But by being exposed to all these different things, when they do have their day, you know that you have a piece of that pie. And I think, we are always going to preach the buy and hold strategy. So don't buy the meme stock because you heard it on a podcast. Buy and invest in companies that you believe in their ethos, you believe in their growth plan, you've looked at their balance sheet. All of that stuff really matters. And you have to, when you're buying something, say, I want to be in this at least 5 years. That's a good, realistic time to be invested in something. If you're thinking, I want to get out in 6 months, it's probably not worth buying at all. And I think one thing I really want to clarify, and Holly, you can help me, volatility does not mean a down market.
Mm-hmm.
So I think people hear the word volatile and they associate a negative connotation, which makes total sense. But really, when we say volatility, we're saying that one day the market is up 1% and then it's down 1%. So when you look at that line, it's really going like that. So that's really what we mean when we say volatility. Holly, you want to add into that?
I think that it's very important for the people that look at their stocks every single day. And I'm one of those that I look at the stocks every single day. And the last few days it's been rough. And but for someone that I've been investing for several years, the market's still doing well overall. It may have had a few bad days, but again, like Elise said, it doesn't mean that we're going into a bear market. It goes up just almost as quick as it goes down. And for those of us that are checking stocks, You do have, and I mentioned this a minute ago, your emotions have to stay in check. You
Mm-hmm.
don't feel the emotions as strongly when your stocks are going up, or at least I don't. But let me tell you, I do feel it strongly when my stocks are going down. And I have clients all the time that they said, I've lost so much money. You have not lost money until you sell your stocks. You're just down at the moment. It doesn't mean that it's going to stay that way.
Say that louder, because that is so important.
Yeah, it's the same way of just saying you haven't earned the money. I always will have people say, oh, I've gained this much in the account, but they don't necessarily say I've earned this much because they haven't sold it.
Yeah,
Same thing as being you haven't lost it.
exactly. And I think too, I think we both have a lot of clients who are actively contributing to their retirement accounts right now. And when there is a bear market, when there is downturns, I really say over and over again, it is okay.
And something else I think it is important when we go to working with the financial advisor is that we talk to our clients about risk tolerance levels, which is so important during a volatile market. If you're a conservative investor, we're not going to put you in stocks, mutual funds, ETFs that have a ton of volatility. We don't want you awake at night with you looking at how up and down the market is. We go more conservative for you. However, I will say for the younger investors, volatility is normal. You just need to overlook it. You need to invest the way that your financial advisor is encouraging you to invest. But I do understand the people that are nearing retirement wanting to rein it in a little bit. That's natural. That's very normal.
Absolutely. And I think like that's a good thing to remember when you are looking at the numbers. So I'd say most of our clients are not fully invested in the stock market. So even a growth portfolio is only 80% invested in the stock market. So when you see those downturns, you're probably only 60% invested. So you're only going to experience that about 60% of the downturn. So keeping that in mind when you look at those numbers, they're going to be more muted in your account because we have other entities such as cash alternatives and bonds working for that stabilization in your account. And exactly what you said, Holly, I think it's just important to know that you are appropriately invested with your risk tolerance. And if you're not, if your financial advisors never asked you your risk tolerance, it's probably something you need to talk about with them or meet with someone else to address, because if you have a very low risk tolerance, you don't want to see that money go up and down and up and down. You want a more steady, gradual gain.
Mm-hmm. And something else, risk tolerance is very important. But another reason you want to work with a financial advisor at almost all levels financially is we want to make sure that you are diversified. I've had clients come in here that they're buying different mutual funds and they feel like they're diversified and they had just growth funds. And let's face it, most growth funds, they're invested in the same company. There may be a little bit of difference, but for the most part, it's exactly the same company, maybe different percentages in invested in these. So if you're not diversified, like Elise mentioned, when that market goes down, it's going to go down across the board for you.
Absolutely. And I think like that happens a lot. You come in and you meet with someone and you're like, well, I own these 10 stocks. And we look at them and they're all growth stocks and they're all tech companies.
Yes.
And
Yes.
that's not diversification. That's actually you're all in one asset class. So you're going to experience a significant decline when that asset class goes down. So exactly what Holly said, I think, what is true diversification and meeting with a financial advisor. So if you're owning all growth, you're owning all apples. You don't have any oranges in there. So it's good to mix it up and it's good to have a variety for the downturn as well as the upturn.
Yeah. So, and I'm also going to pivot for just a second and go back to the presidential election and the volatility, because I mentioned this is a question that we get on a regular basis. And a fun fact that Elise and I learned when we were at our Las Vegas conference a few weeks ago, that typically Groundhog Day is more volatile than like an election year, which
I
to
love
me,
that statistic.
I know, I thought it was amazing. And also, the market is normally more calm during a year where there is an incumbent president. And this year is especially extraordinary because we've got two. Now, granted, I don't think it's a typical election. The election itself is not typical. The market during this time of the year, I feel like it just is. And we've already been warned. So for those of you out there that are listening, that you just need to brace yourself for September and October. It's going to be volatile. It doesn't mean it doesn't mean that we're facing a bear market. It just means that there's going to be lots of ups and downs during the day. And the one thing that I tell my clients is don't look every day. There's really don't. If you have a financial advisor, have them looking at your accounts. Like, take a look maybe once a quarter, every 6 months, once a year, especially if you're not near retirement. Put the money in there and forget it.
Exactly.
The majority of presidential election years still come out ahead. So I guess my 2 cents in all of this is make sure you have a financial plan and you stick with it. Don't let your emotions get involved with like all what news media is spouting and creating the fear.
Absolutely. And I think like a lot of people call when news is bad. And the number one thing I want to say is the news and the market are not correlated. So if all bad news is coming out, that doesn't necessarily mean that the market is going down. It could be going up. So it really isn't correlated. So when you feel like the world is ending, go to Yahoo Finance, look at the stock market, and you'll see like it's not a correlating factor. And really just being able to tune out news, I think, is so important in our day and age where news is so available. It's so in your face. There's a news story every 5 seconds. But getting to that point where you can tune it out and be kind of detached from your investments, because, Holly and I have definitely learned through our experiences ourselves, but also with our clients, investing is emotional and money is emotional, even though we don't want it to be. We want to be rational investors. But the truth is we get attached and we don't like seeing it decline. So understanding that and being able to understand why you feel the way you feel and still being able to process and make rational choices is so important. And that's where we come in as advisors. We're able to be a more unbiased opinion and be able to guide you through those really tough moments where, 2007, 8, 9, a lot of people ended up selling out of the market, where if they were able to just stay in, they would have seen a lot better of an ending outcome.
Yeah, and that's definitely one thing that I want to reiterate is for those of us that are financial advisors for you, if you can feel those emotions getting the best of you, reach out. I mean, that's why we are here.
Absolutely.
Is to help talk you through this process. We want you to feel comfortable in investing. And I think when we create a financial plan, it is our job to see that plan through and to take the emotion out. Because again, like I understand looking at the stock market and I see my stocks go down, I understand the feelings of it, but I also understand it's a long-term investment. I'm not going to react on it. I may feel it, but I'm not going to react on it. Reacting on it is not going to meet my financial plan. And so it's important to have someone there to just guide you and reiterate. And also we have to keep up with all the economic updates. So if there's ever a point that we feel like how you're invested is not wise, we're going to tell you. So again, that's why it's so important to work closely with a financial advisor.
Absolutely. I think at the end of the day, we're professional handholders and we don't mind being that for our clients. We love to talk you off the ledge and say, it is going to be okay. And, most of the time, the world is not ending, even if it feels that way. So you have to ride it out and ride it out for the long term. I think that's all really good advice, Holly. Is there anything else we need to throw in before we wrap this up today?
I think that pretty well covers it. I think that this is just a very timely topic. And again, I just want to reiterate, we're here. Reach out to us. Even if you're not a client and you just want to talk about some of this stuff that's going on. Again, we always offer free consultations. So never hesitate to reach out to us.
Absolutely. So thanks so much and tune into future episodes or go back and watch some of our old ones. We have some great content on there that is so useful for anyone starting their investing journey or in the middle of it and just looking for some good advice.